Hi, Sharuka AITA CPA with AITA Tax and Accounting, and this is another weekly tax tip. We are talking about the new Section 199A of the Tax Cut and Jobs Act, which gives 20% deduction for pass-through entities. It's a great tax saving if you are a small business owner, and it's 20% on a qualified business income. What is a qualified business income? It's basically your income minus expenses from selling products or selling services. However, it does not include the salary that you take if you were a shareholder, or it does not include guaranteed payments if you were a partner, or interest, dividends, short-term or long-term capital gains. So it's basically the income from an operating business through a pass-through entity. And remember, talking about pass-through entities, these are the entities that all the profit transfers to the personal income tax return. So you do not pay tax at the corporate level. No, all the profit transfers to your personal income tax return, and this is where you pay the tax. And for example, pass-through entities would include S corporations, partnerships, LLCs, LLPs, sole proprietorships, and those are the ones that receive a 1099, for example, and you file a Schedule C. Now, when the IRS calculates the 20% deduction, you take it on each qualified business income individually. So let's say you have two businesses. We would calculate the 20% on each business separately. However, if you have a loss on one business, that loss goes against the profit from another business. And if some of the loss was not used in the current year, it would be carried forward to the following year. But the best thing, about the 20% deduction, let's say that your qualified business income in your business $100,000, you get 20% deduction. That's a $20,000 deduction. So you only pay tax on $80,000 deduction. The way we calculate that 20% deduction can get a little bit tricky, but the IRS has provided thresholds. There is a lower threshold and there's an upper limit threshold. And I think putting it on the board and seeing those thresholds will help you understand where you fall into this equation. So now, if you are single and you earn less than $157,500, or if you are married filing joint and you earn less than $315,000, this is your taxable income. If your taxable income below these numbers, if you were single or if you were married filing joint, there is no limit on the 20% deduction that you can take. So just because you have a pass-through entity doesn't mean that you're entitled for the full 20% deduction. It can be limited, or you can lose the whole 20% deduction depending on the type of business that you are in. So when your income level starts increasing, and there is an upper level that the IRS has provided, so would help us calculate the limitation on the 20% deduction. When your income starts increasing, and I want to put the upper limit of the threshold, it increases by $50,000 for single, and it increases by $100,000 for married filing joint. This is the upper limit. As we said, if you make less than $157,500 if you're single, $315 if you are married filing joint, you get the 20% deduction. Simple calculation. When you start making above that number, well, it depends on the type of business that you are in. The IRS has said if you are a service provider business, that means if you are an accountant, lawyer, a doctor, consulting services, athlete, an actor, and it excludes engineers, okay? So if you are providing service, then if you make above $205,500, and if you were single, or $415,000 if you're married filing joint, you don't get any of the deduction. The deduction will be phased in, and it would be limited if you are between those thresholds. But once your taxable income goes above those limits, you lose the deduction. Absolutely. However, for non-service providing businesses like internet services, marketing, coffee shops, restaurants, these type of businesses, the deduction will be limited based on a wage limit or depreciable property limit. So in order for you to take the deduction, you either need to have wages in your business or depreciable property. Let's take an example. I think it will help us understand it better. Let's say Alex has a coffee shop. Here's Alex. And he has a qualified business income of $100,000. His taxable income on his tax return is $120,000. Now, since Alex is single and his taxable income is below the threshold, he's able to take the full 20% deduction. Okay? The full 20% deduction, $20,000 off. However, let's say that Alex has $300,000 in qualified business income. And his coffee shop has employees with wages of $50,000. This does not include your salary as a business owner. No, this is employees' wages, okay? Wages. Your taxable income, or Alex's taxable income on his tax return, is $350,000. You know, he has other sources of income. It comes down to $350,000. Looking at the threshold, he's way above the threshold for single filers. So now his 20% deduction is limited. The maximum Alex could have gotten on the 20% deduction of QBI is 20% of 300, which is $60,000. That's the most he could have gotten. But because his taxable income is way above the threshold, he is limited to 50% of wages. 50% of 50 is $25,000. And then we take the lesser of the $25,000 or $60,000, and he only gets a deduction of $25,000. Now imagine if Alex has employed more employees, and the wages that he pays his employees are $100,000. 50% of that would be how much? $50,000. So now his deduction is bigger. It's the lesser of that $50,000 or $60,000. Now his deduction is $50,000, not $25,000. So this tax bill was enacted to encourage small business owner to have more employees, to hire more employees, or if you don't have employees in your business, depreciable property would help you out. So for a business that has a rental income, having depreciable property, depreciable buildings, that would also give you the deduction. But if you don't have employees or depreciable property, you will not get the deduction once you are above these limits. Just be mindful of that. I hope you liked this video. I know this was a lot to take in. If you have any questions, please go ahead and give us a call. Check out our website AITAtax.com, and follow us on Facebook. Thank you.